the MacroAce trade prep for FOMC. Hopefully you guys can all hear me. If everyone could just give me a quick shout out where they're from, and what are they going to be trading the FOMC today, or they're just going to be keeping an eye out for what comes along and see what kind of happens. Where are we all joining from? This is your host Tony. So it's kind of cold here in the UK. We've had some Sahara desert sand blowing our way in the UK, so my car has been dirtied with some desert sand a little bit. But yeah, if you guys can all hear me okay, just give me a little thumbs up if there's anything that if everything's all good from your side. Silis013, could you raise your volume? Yes, can you hear me all right? Can you hear me okay? You should be able to hear me fine. S Shah says yes. You might have to raise your volume on your side as well, a little bit. You can see the sound is all fine on our side. There we go. Should be even better. Okay, so I can hear you, but it's really low. That shouldn't happen. Should be loud and clear. Okay, you might have to, from your side, you might have to put it up a little bit. Sajad, yes. Where are we all coming in? Where are we all listening in from? For those that are jumping on in the chat, or anyone who's watching this at the moment. Sounds fine, mate, says Paul Duplessis. Thank you very much. So S. Shah says LA. Paul Duplessis says South Africa. Great, good to hear. I'm sure you guys are enjoying the weather over in Los Angeles, South Africa. Sajid says Stoke-on-Trent. There's okay, cool. So you're probably not enjoying the weather as much as I am. You're probably not enjoying the weather as much as I am. Silas from Miami. Great. Good to see this here. So let's get into it. We've got an hour of prep before we get through to the where am I based? I'm currently based in London at the moment. So that's where we are at the moment. But yes, so FOMC prep. Let's get right into it. We've got a lot to cover. So what is it? So these meetings, S. Shah says beautiful sunny. So California has a little overcast today. Fair enough. Still better than ours. Still better than our weather here. So go back to the FOMC. So these meetings roughly happen every 6 weeks over 2 days. So it would have started yesterday and concluded today. And this is where the Fed, or the central bank of the US, sets their policy and federal funds target range. Currently, that range is at 0% to 0.25%, and the current interest that we're focusing on is at the 0.25% mark, and that's what everyone refers to when we're looking at the Fed interest rate decision, is the high end of that rate at 0.25%. The reason why it's important, of course, with interest rate decisions, particularly from the US and the major central banks, it causes a lot of volatile moves in the markets, and then for the economy overall, has a wider effect there. Also, with the Federal Reserve being the main central bank that everyone keeps an eye on for what they're doing, it may also influence other central banks to follow a similar rate path of hiking and withdrawing stimulus, or as we've seen previously, that isn't always the case, considering with the COVID pandemic and how we've had the Bank of England, the Bank of Canada, and the Reserve Bank of New Zealand already raising their interest rates and tightening their asset purchases sooner than the Fed had done. So that's the reason why it's important. And let's go through the next point here. So how does it affect the markets? So usually with the currency, what we usually see is when interest rates are hiked, the dollar would usually appreciate. That being said, is the main reason being is that foreign investors, if they see that the greenback is more valuable off of the back of an interest rate hike and further tightening in monetary policy, then that means that they would get a high return for investing in the dollar. Also, for others who trade and do business in the dollar as well, of course, they would make more of a profit if they're selling goods in dollars as well. For bonds, the main thing for bonds being most bonds pay a fixed interest rate, and that becomes more attractive if interest rates fall, driving up demand and the price of the bond. Now, that's when interest rates are cut. But when interest rates are increased, usually for the bond market, what you would tend to see is that the yields would increase, and we'll have a look at the prior reactions from the market is what we see. And then the price of the bond would decrease. Of course, when the central bank raises rates, they're trying to rein in the amount of inflation or strong economic growth. They're not trying to stop economic growth. Their challenge is and what they're trying to do is to slow the economic growth to where they can keep inflation under control and make sure that economic growth doesn't blow out of proportions where it's too high or too strong for the Federal Reserve to be able to do any substantial or take any substantial steps in order to rein that in, or stopping the Federal Reserve from needing to take aggressive further steps to rein in inflation and rein in strong economic growth if needed. For the stocks and indexes, and what we've seen from the prior market reactions, when there's been talk of the Federal Reserve reducing or removing amounts of asset purchases from the markets, and also talking about, and also the talk of raising rates soon, and not giving even when there wasn't a clear defined timeline given of when interest rates would be increased. For those assets, indexes, we had seen a depreciation in their value. The main reason being is that when interest rates are raised, that means that companies have to, and businesses will need to pay more money for the goods that they purchase, and in turn they would make less profit. That's the basic effect of what happens when rates are raised. So one thing I also wanted to have a look at here is from Morningstar, being cited by Forbes magazine. They'd put out that for the indexes, they'd put out this little image of returns following first interest rate hike. This is prior reactions that we had seen. And usually, so for people who are kind of unsure how rates work altogether, if you think, in the short term or in the long term that rate hikes will affect stocks in a negative way, then this image and this chart that we see here with some figures proves that wrong. The reason being is that when the rates are hiked, what that means is that usually the economy is back on a growth path, and the economy, if it's expanding at a stronger rate, and inflation usually if it is expanding at a stronger rate, then the Federal Reserve, as said, slow the economic growth down, but not completely, can raise rates, and it means that they believe that the businesses and the economy will be able to weather interest rate hikes. So from what we see here, we've seen that over a 12-month, so following 12 months of the first Fed rate hike, overall for US stocks, there's been about 7.3% appreciation between 1994 and 2021, or between this or the timeline that they're given there. And then here, so when the first rate hike when they're talking about an interest rate hike happening. So back in 1994, we had the rate hike happen there. In the next 6 months, you'd seen about minus 2.6% depreciation in US stocks, but by 12 months, you'd seen an appreciation of 2.5%. As you can see here, so in 99 there was a 9%. In the next 6 months, there was about 9% appreciation and 8% appreciation by 12 months. And then in 2015, there was about a 1.4% appreciation, and then by the 12th month, we had seen 11.3% in appreciation. So this is more for economists if you're not thinking about the short term. Whereas in the short term, you would see indexes see depreciation from a rate hike happening. But in the longer term, what we can see is that when the rate hike does happen after the first one, that you see this appreciation in stocks. Again, that the central bank is more confident in the economy, and that will lead to sentiment of businesses being more confident and being able to borrow more money confidently to be able to create the products and goods that they need to, and also provide the services as well to consumers. Is everyone kind of clear on that so far? Does anyone have any questions or any thoughts so far? What I've just kind of covered before I kind of move on, or are we all okay? And do we understand what I've just said? Is there anything anyone would like me to kind of go over again? We've got this whole hour to kind of prepare ourselves for the interest rate decision. Okay, so let's carry on. Now, the Sajid says, how will the rate hike affect oil and gold? That's something that we will have a look at in a little while with the market reactions from what we've seen, from what we'll look at. Usually, now if we're talking about intermarket correlation and how that affects the markets, when the dollar sees an appreciation in value, gold usually tends to see a depreciation in its value. Of course, gold is seen as more of an inflation hedge, but when the dollar appreciates in value, gold sees a depreciation usually. For crude oil prices, for oil prices, if we consider that oil is bought in dollars, so the stronger the greenback is, the cheaper it becomes to buy oil. So just to bear that in mind. But we will have a look at the reactions that we had seen in the markets a little later on in the markets. Wade Swain, hey, hello. How are we doing? You okay? I think you recently subscribed to us too. I think that was after the first webinar that I did today about retail sales and Canadian inflation. When inflation is this high, why is a 0.5% hike so unlikely? This is what I will go through. So keep that comment there. I will go through that. I will go through that there in a little bit. First, let's kind of get through this point here. So the previous FOMCs that we had. So in November, we had on the 3rd, we had the Fed starting their tapering of asset purchases, and off of the back of that, we had seen the depreciation in indexes and an appreciation in the dollar. What they had mentioned was that they would look to finish the asset purchases by the end of March. So that initially gave some traders the idea that the Federal Reserve might start to hike rates by then, but there wasn't a clear-cut comment from the Federal Reserve of the timeline. And so with the 26th of Jan is where we had the interesting reaction from the Dixie. is where we said it will be appropriate to raise the target Fed funds rate soon, and that they expect that reducing the balance sheet size will start after the process of increasing the target range, i.e. when we get the first rate hike today, for the federal fund rate has begun. It was also reiterated that if risks arise that obstruct the Fed's goals, the Fed is prepared to change its monetary policy stance as needed, and job growth has been strong in recent months, and the unemployment rate has dropped significantly. So when we had those comments from the Federal Reserve on the 26th of January, there was no clear-cut timeline given for when a rate hike would happen. They only said that the rate hike that it will be appropriate to raise the target Fed funds rate soon. So the initial reaction that we had seen was that the Dixie had saw an initial weakening, but knowing that the Fed hike was going to come soon and that they're talking about it more so, then we had seen the dollar index start to move back towards the upside. So this is the situation. So going back to your question then, where it's DryZ 1337, where you say, when inflation is this high, why is 0.5 hike so unlikely? Now, the reason why it's unlikely is because of, first of all, you have the Russia and Ukraine conflict that has caused such a has caused such a volatile reaction in the markets, where the indexes had all declined and the dollar index had shot up and had appreciated. Where there was a risk-off sentiment, where everyone went to safe haven assets such as the dollar, gold, Swiss franc, the yen, and they also went into, and then they also moved away from risky assets such as the indexes and stocks, and also WTI crude oil prices had appreciated. Now, one of the comments that I will be going through is that where Powell has said that every meeting was live, i.e. that the March meeting, of course, where they're going to be expected to hike rates today, is where we're going to see the interest rate decision being hiked, and then every meeting after that would be live, where they would hike interest rates. The other reason why there's going to be other reason why is that there's going to potentially, again, it's kind of on the sidelines. So saying that 0.5% hike is unlikely, there's yes and no. Traders erased their bets for a 50 basis point hike back in February, when the Ukraine-Russia conflict had kicked off. So fearing that the Federal Reserve may take a more cautious approach to the markets and to tightening policy. But with inflation, yes, it is at a 40 high at 7.9%. So that does kind of beg the question, and you have had a couple of Fed members talking about 50 basis points of hikes or more hikes, i.e. the number of hikes is increased to kind of make up for that. But again, the 50 basis point hike, if we look at the Fed funds tool as well, there we go. Okay. So here we can see, so now if you are banking on a 50 basis point hike to the next target range, don't forget these target ranges move up by 25 basis points. So there's a 98.3% chance of a 25 basis point happening today. And then if we're looking at the 50 basis point, as I said, there's a 1.7% chance. So I remember about a couple of weeks ago now, where here it would say that there was a 0% chance of a 50 basis point hike. But now, as we can see, that's near enough not changed. And you can see here, back in February 16th, there was actually a 45.3% chance of the Fed hiking rates by 50 basis points, according to the watch tool, and about a 54% of the Fed keeping it at 25 basis points. But since the Russia-Ukraine conflict, those bets have been raised near enough to where the point or the view doesn't matter. So just to bear that in mind for the FOMC, again, sentiment took control and led us to where we are at the moment now, of markets only expecting a 25 base point hike. Okay, so one other thing that I wanted to go through as well is the meeting, is the statement that we had received from the Federal Reserve in January. And it's interesting to kind of see that the language that is used, what has caused a more hawkish reaction from the markets. Seeing here, what else do we have in the comments? Costa says, but why will FOMC hike interest rates when it's not done tapering? So you've also got to consider the Bank of Canada. If they were to completely strip out the asset purchases altogether and then hike the rates, that would mean that the transition from a dovish stance to a hawkish stance, i.e. where there isn't a need for stimulus, would be have a very negative effect on the economy. The reason being is that if I was to say, okay, at some point I'm going to take £100 from you that I've been giving you for the next 6 months, and if I said, right, I'm going to take that all together away from you, then you will kind of be left with nothing to transition from. You would be, this is the thing for companies and also banks as well. They won't have a supply or cash flow to draw from whilst the transition is happening. So it's important for the Federal Reserve to take this cautious approach where they don't strip away asset purchases altogether, but they rather do it gradually, which is what they have said. But that doesn't mean they can't hike rates at the same time too and be dynamic, i.e. they can do two things at the same time to control inflation, but also make sure that the markets don't see a negative reaction, and also make sure that banks or the other banks don't have an adverse effect on themselves either. Okay, so hopefully that answers your question. So ECB is doing the same as the Fed, just a bit delayed. Well, the ECB is a different story altogether, and I'll go through that a bit later. So the Federal Reserve in the last meeting that we had, this shows us the change in the language from that meeting. So, of course, with the COVID pandemic, once we had seen a bit of a recovery from COVID-19 on the Omicron variant, when that took precedence or from precedence in the markets. So the Federal Reserve getting around to this point here where they're committed to using its full range of tools, i.e. withdrawing the support for the economy, okay, via monetary policy. So that bit was removed. And again, you had the change in tone where they said that with inflation, instead of saying with inflation having exceeded 2%, i.e. just kind of clipping 2%, they've gone 10 more hawkish and said well above 2%, and with a strong labour market. And also the new bit here saying that the committee expects it will soon be appropriate to raise the target rate. So just to bear in mind the colours as well. So the red underlined text is the new words that have been added in to the comments. And of course, the crossed out bits are the bits that have been redacted or removed, replaced. So again, the committee expects it will soon be appropriate to raise the target range. And then you've also got the point where it says further down below here that federal funds rate, it says that the committee decided to continue to reduce monthly pace of its net asset purchases, bring them to an end in early March, beginning in February. Right, so it's gone from January to February. So they've been holding on to these asset purchases and providing providing that support for a bit longer than they had anticipated, compared to the prior FOMC statement that we had seen, which we'll have a look a bit later. But altogether, we had seen more of a hawkish stance taken from the Federal Reserve in regards to removing stimulus and then making sure and then giving and just saying that they're looking to raise rates soon, and that's appropriate to them. So if we go to the other meeting now, so this was January versus December. If we look at December versus November, I'll bring that up here for us. Okay. So here they've said that here they've got rid of the bit that of saying that this in regards to COVID back then, the sectors most adversely affected by the pandemic have improved in the recent months, continue to be affected by COVID-19. Instead of saying, but the summer's rise has continued to be affected by COVID-19 pandemic. So there was those issues that were still lingering for the Federal Reserve. Jobs gains have been solid in recent months, and unemployment rate has what they removed has slowed their recovery, and inflation is elevated and largely reflecting factors. So back in December, overall, we had started to see more of a hawkish turn. There was still some dovish people. There was still some dovish comments coming through from the Federal Reserve back in December. But that, just as a historical point of reference, we had seen just sort of the switch of what originally was put out in the last FOMC statement to what we are currently seeing, to what we had seen prior as well. Galaxy 1 says, guys, get the likes up. 30 peeps watching. Awesome. That's pretty good. Galaxy 1 says, I saw a chart a long time ago that showed the dollar's price is mostly pre-positioning itself ahead of a potential rate hike. Is this true? Well, if we consider with the Bank of Canada, where rates were expected to be hiked, the reaction did see the Canadian dollar seeing appreciation, but it wasn't huge. You've also got to largely because it was expected. So does that mean with the Federal Reserve interest rate will get the same reaction? That we're yet to wait and see what kind of reaction that we get, whether that does kind of replicate into the markets from what we had seen from the Bank of Canada. But there is a possibility. I'm not saying that will happen as a certainty. So, going back to the presentation then. Now, it's key to understand the comments that we had received from Fed's Powell as well, and also from other Fed members as well in the lead up to this rate decision that we have today. So Powell's comments in the Senate committee hearing said that I believe it is appropriate to raise interest rates by 25 basis points in March. Fine. Everyone, as Galaxy 1's kind of hinted towards that, is it already priced in? A lot of it, from what we had seen, there was some pricing going on. But with the Ukraine-Russia situation, that kind of leaves the door open, or whether or not, or how much of that has been priced in, and how much of that has kind of reversed with the choppy volatility that we've seen from the Ukraine situation. March 3rd, Powell said that if we had known inflation wouldn't improve, we would have used tools sooner. But there's something that's kind of keeping them from being taken more of an aggressive decision to hike rates, or more of an aggressive stance or hawkish stance. And then Powell says, if inflation doesn't fall, I am willing to increase by more than 25 basis points in a meeting or meetings. So bearing in mind we had the recent inflation report from for CPI, but also what their key inflation measure is the PCE price index is what they look out for. So if we bear in mind what the PCE price index is at the moment, and if we have a look at it here, if I just bring it up for you, the PCE price index, from what we can see, okay, so back in February, so the PCE price index of what we had for the year on year, which is the Fed's main inflation gauge, was 6.1%. And if we compare that to inflation, or to the CPI, where we received 7.9% inflation for the month, that's being at a 40-year high. That factors into, or that should factor into the Fed being a more aggressive, and with their, first of all, removal or reduction of balance sheet, and also their rate hikes. So PC price index, if that's already quite high from what we've seen, then that should play into the hand, or should have played into the hand of the Federal Reserve. So again, we'll wait to see what Fed's Powell says later on in his statement or in the press conference, and whether he does consider the PC inflation to be quite high or too high, if he does consider that inflation isn't falling from his point of view. So that will be looking on the clarity from there, and whether that would mean a 50 basis point hike somewhere down the line, or whether we stick to the 25 basis point hikes. Other Fed members, and so particularly the voters that we have, so Williams, Bullard, George, Brainard, Bowman, Mester, and Waller, and Harker. So Williams, who is on one of the governors on the board, says that he sees a Fed lift off during the March meeting. Again, a lot of this has been drilled into the markets already. So again, has a lot of the market would have already priced this in. March 2nd, we had Bullard, who urged for a quick withdrawal of policy accommodation, while Fed's Evans said that monetary policy is currently wrong-footed and has to be moved upwards towards neutrality. Bearing in mind, with Fed's Bullard, he is a very hawkish member. So if I show you the doves and hawks, so we get a better understanding of where these Fed members sit. So a good site that I have is the ITC markets. What we can see here, we go. So Fed's Bullard is viewed as a very hawkish member of the Federal Reserve. So the comment of him urging for quick withdrawal of policy accommodation isn't unexpected. It just, at that point, it just in a way aids. It just gives us an idea that we'll have a dissenting voter who will look for a higher rate hike rather than 25 basis points. But he hasn't really made that clear or explicit, as we've seen below here. So Bullard said that he favors 100 basis points in interest rate increases by July the 1st, and he defers the 50 basis point increase in March to Powell. Now, as said, Powell hasn't made it explicit with saying that a 50 basis point increase is necessary or could be needed. At the last Senate committee hearing that we had from him, but there hasn't really been a strong calling for a 50 basis point hike from other members. We have had Fed's George on the 14th of Feb saying the March expectations of a half-point rate hike in March paves the way for Fed debates. So saying that it's there, but there needs to be more of a discussion around it before an actual decision is taken. Brainard believing that series of rate hikes should begin next month, like today. Bowman saying that that they're in favor of hiking interest rates at the March meeting. So again, this point being driven of a 25 basis point hike today has been driven in quite well. Mester says she doesn't believe a 50 basis point rate hike in March is compelling. And again, just citing, because of the Russia-Ukraine conflict, there are downside risks to growth and upside risks to inflation. And that's the key point, as said, for why the market bets have reduced their chances, or reduced their bets of 50 basis point hike in March, because you've got the Federal Reserve, or some Federal Reserve members seeing it as an increased risk to the economy. Fed's Waller says there's a strong case for a half-point raise in March if new data shows the economy is faltering. We'll have a look a bit more into that later on as well. Fed's Harker said that the Fed might raise. This is going back to February the 1st, so way before we had the Russia-Ukraine conflict. He said that the Fed might raise rates by 50 basis points, but I'm less inclined towards that currently. So overall, a lot of Fed members, voting members, looking for 25 basis points in hikes. The voting members, some who were considering, who were thinking of, or who were talking about 50 basis points of hikes, but saying that it should be rather left to a debate or left to Powell's decision. Of course, if there was a mention of wanting 50 basis point hikes, the markets, from what we'd seen from Bullard's comments, we had seen a risk-off reaction where the S&P 500 had seen a depreciation, and also the dollar had seen an appreciation. So if I was to bring that up to show you guys what we had seen when we had Bullard make those comments. Bring it up. Okay. Just wanted to get the reaction for you guys of what we had seen from the prior time that Bullard had made a comment about 100 basis point hikes. Here we go. Perfecto. Oh, no loss of it. There we are. Okay, perfect. So, if we see from there, so this is the so that was the Dixie, that was the S&P 500, and that was gold from what we had seen. So the Dixie had seen an appreciation in its values, and the Dixie had seen an appreciation in its value. The S&P 500 had seen a depreciation from the figures from the comments that Fed's Bullard had made. Again, as said, being the very hawkish voting member of the Federal Reserve, that had caused a stir in the markets, that maybe that could be the overall thought process of the rest of the Federal Reserve. So even then, back in February 10th, when he said that, I said the S&P declined. Gold had seen a depreciation as well. So the talk of rate hikes and how much the rate hikes could happen by has really overall caused a risk of reaction. So if we're talking about, if dry Z1337 just saying, do you think the comments from Bullard has an influence on other members? Well, bearing in mind you have these voting members and non-voting members that have their own points of view. I think for them it's something that they take into consideration, considering the last comments that we've had recently, where they haven't been explicit about, where they haven't agreed with Bullard's point of view for 50, for looking for quicker withdrawal stimulus, or taking stronger, or taking a more hawkish and aggressive stance in monetary policy. Since that comment was made, it's more or less opened up the discussion to say, well, it's up for debate, but it's not something that they're concrete on. So to a degree, if a Fed member does bring it up, it's not something that they will ignore altogether, but it's more left up for discussion to see what a 50 base point hike would mean for the Federal Reserve's monetary policy transmission, and what that means for the economy overall. So one thing they don't want to do is to stifle growth as one of the points. Hence, they're going up from what they could do today is go up by in increments of 25 basis points. So that's one of the arguments that's put forward there for whether they do listen to, well, that's the both points of view, if they do listen or have been influenced by Bullard. Okay. Right. So investment bank views. I'm cautious. We've got about 20 or 18 minutes until we get the rate decision. Getting close. So Bank of America sees the Fed hiking cycle kick off with 25 basis points today, and will likely release their comments about balance sheet normalization. And they expect a hawkish tone from Powell, and the summary of economic projections, which we'll also get, of where they see the economy going, should put where they believe that should show a pull forward in hikes, high inflation, and lower unemployment rate. So even from the non-farm payrolls data that we had seen, which was quite strong, which was much better than expected for this month. So that could factor into Powell's comments as well today. 14th of March, we had Standard Chartered saying that they're not convinced that the Fed will be so hawkish as to indicate upcoming 50 basis point and an upcoming 50 basis point hike. They add that the central bank is unlikely to consider dovish scenarios without clear signs of slowing economic growth, which isn't happening at the moment, where we're seeing actually the economy is doing quite well at the moment. They expect FOMC members to project 5 hikes this year, while lagging real wages and falling disposable income will lead to a pause after July. Goldman Sachs, with their point of view, saying that the dollar has appreciated further this month, and the Ukraine conflict seems unlikely to dissuade the FOMC from raising rates. They forecast 7 rate hikes of 25 basis points, followed by 4 more next year, to bring the terminal rate back to 2.75 to 3%, or 3%, from its current level of effectively 0. So then you had CNBC citing JP Morgan that the economic outlook supports the Fed's current plans to boost the federal funds rate in March and to begin to reduce their balance sheet over the summer, according to David Kelly, chief global strategist for JP Morgan Funds. However, there are a number of areas of uncertainty which should make them a little more cautious in tightening. Again, markets and investment banks now was as well seeing a more cautious Federal Reserve in regards to whether there would be a 50 basis point hike, more leaning to the 25 basis point hike scenario. And then from the 14th of March, you had Fed swaps that moved to fully price in 7 standard hikes, or 7 interest rate hikes for this year. So that's what we have from there. Now, is everyone kind of clear on the market reaction? The investment bank views from what they've said? I've got some more questions. What else? Do you think the markets will wait for the conference to do big moves? That I cannot say. I think and we'll go through the market reactions as well. Market reaction more recent prior as well. that's more for debate. That's as I said, if the market's already been told that 25 base point is going to happen, and they've been trying to price it in during the Ukraine conflict, which has seen a risk of reaction. That's difficult to tell, really, to see how the markets will react to that there. Okay. Right. So let's go to the market reactions. What I want to show you is the previous release we had. So 26th of Jan, if we go there. Okay. And then okay. Right, so let's have a look at the ES, or the S&P 500, or the reaction was from that release that we had, or the data and the comments that had come out as well. Just to bear in mind as well, so the not only is the where the rate is important, but also the comments that come through as well. So if we play that there, if it wants to play. Okay. Alrighty, so about 10 seconds away from the release coming out, or the 2 p.m. mark. All right, so the S&P saw that initial move towards the upside. The dollar yen saw an initial move towards the downside. That was from the comments of the Federal Reserve, as said at the beginning of the webinar, of the beginning of this stream, where they had said that rates could be raised. It would be appropriate to raise rates soon, but no timeline was given for that. So that was the main comment that had caused this initial decline from the dollar. It's seen this initial movement towards the upside on the S&P 500 from that from those comments that we had there. So we keep going, and if we have a look at other little bits here too. Okay. So overall, we're looking at deviations and how much everything moved up by. So the S&P 500, if we pause that there. If we bring that over. So what we'll do is we'll now just see how much the market moved by. But what we can see, what we had seen from the S&P 500 in the first candle to the top of the wick, we had seen the S&P 500 move towards the upside by about 90 ticks towards the upside in the first candle. Nasdaq about 431 ticks, and dollar yen about 6 pips down on that initial movement. The euro dollar had seen about 16 pips up. GBP USD, or cable, seen about 18.5 pips towards the upside. Dollar CAD about 21.5 pips towards the downside, and the US dollar to the Swiss franc, we'd seen about 8 pips towards the downside. On the 2-year, remember that's the bond, not the yield, we'd seen about 9 ticks towards the upside, and the US 30-year had seen an initial move towards the upside, but then had seen 2 ticks towards the downside. So overall, the reaction was very strong on the S&P 500, of there being no clear timeline for when the Fed interest rate decision, or when the rate hike would occur. I think, hopefully, as people have kind of jumped on, I hope they haven't kind of just seen me play a reaction and think that's the actual release. Hope not. But yes, so that was the initial reaction we had seen from the Fed, not giving a timeline of when they would hike rates, but just saying it will happen soon. So we keep playing this, and then we'll see that reversal on the S&P 500 and also the dollar yen at some point. But we've also got to bear in mind today, there's been some, yes, so all monster high. Yes, you are correct. There has been Russia news that has dominated the news today, and has also dominated the markets overall. So if I just bring that up for you, what we've seen overall. Now, with the Russia-Ukraine conflict, I've already mentioned we had seen a risk-off reaction from the markets, where the S&P 500, where the indexes, the dollar had seen a huge appreciation, and WTI crude oil prices. When there's uncertainty around supply for oil, then the price of crude will go up. The price of crude will go up when there's more uncertainty surrounding that. But when there's not a war going on, then the markets will stay stable, and there won't be the extra volatility that we have seen in the markets. So I want to show you guys where it currently sits at the moment with the S&P 500, gold, where we currently sit, and then also we'll also keep an eye on crude oil prices too. Okay, the S&P 500 still making its way there, is what it did. If we go to January 26th, we open up here. So after that initial move towards the upside, so from what we'd seen, I just kind of zoom in. Just make that big screen. So what we had seen is we had seen the S&P see that initial rise after the Fed said after the Fed didn't give a clear timeline. And then the Dixie had seen that initial move towards the downside, and also on the, so this is on Bitcoin here, what I can see if I just kind of zoom out. And then gold, from what we had seen, gold at that time, at around 2 p.m. Eastern time, had seen an appreciation off the back of the depreciation on the dollar. But then we did see that reversal happening, and we moved back. It moved towards the downside, and then the dollar had moved towards the upside. Again, that's when the talk of a rate decision or wasn't clear where the Fed path was going. So from that uncertainty, the S&P kind of captured that and let the ball run with it. If I just refresh it there, let's go back to the market reaction here. So if we look here, so the initial move towards the upside there, and then the realization, of course, that the rates are going to be raised soon, is when we start to see some weakening from the S&P 500. But the initial move towards the upside, again, the language and the text and the comments that come through is going to be quite key for later rate hikes. And of course, the path of what we're looking for is whether or not a 50 basis point hike would be appropriate. And second of all, how many hikes are they looking to do this year to bring rates to around 3%? And then, of course, don't forget the balance sheet runoff as well that the Fed needs to reduce and remove at some point altogether. We will also be looking out for comments from there. So if we do see that there's more of an incline to hike rates by 50 basis points, then that'll be more of a hawkish sentiment and a bullish sentiment for the dollar. And for the indexes, a 50 basis point hike discussion or comments coming through about that wouldn't be so positive for the S&P 500 or the indexes. And we'll see gold would also see a potential move towards the downside, if a stronger move towards the downside, if we see comments about 50 basis point hikes or any further cementing of how many rate hikes are going to occur. The bond prices could potentially see a move towards the downside off of those potential comments that we could get from the Federal Reserve. So overall, first of all, as kind of said, if we look back to what we can currently see at the moment in the markets, where are we? Where is the Dixie? How much is the S&P 500 up by? So we can see the S&P is already up by about 1.36%. Now that's off the back of today's news from the FT saying that there was a plan in place, or 15-point plan with Russia and Ukraine to de-escalate the situation. From the Financial Times piece, which had seen this risk-on reaction, which has now been eroded away, but still S&P 500 is up on from what we can see here, by about 1.3, by about 1.4%. Crude oil still up, but a lot of it, if I put it on a higher time frame, a lot of that power a lot of that strength had been eroded because of the positive discussions that had happened. First of all, of there being a potential ceasefire. We've got about 3 minutes, by the way, so I'm just cautious of that there. So there being a potential ceasefire between Russia and Ukraine, and there being open to talks and having discussions, had played a negative or a bearish sentiment on crude oil prices. And then gold is currently down about 0.5 at the moment. So just to bear that in mind of what we can see in the markets. So hopefully that kind of makes it all clear. We've got about 3 minutes left to go. That's basically what I wanted to show you, the main bits of that. Let's keep our eyes on the ES and the dollar yen. So let's go back to our feed. And let's get this back up. Okay. Right, just gonna bring on a new chart. Let's get the ES. Let's get the S&P. Okay, there we go. It's a bit more live. Right. Add in USD JPY. Oof, got about a couple of minutes. Okay, couple of minutes. Look at the bonds here as well. All right. Okay. Right. A minute to go now. Hopefully you guys can all see that clearly. About 30 seconds. There we go. $19. $10 seconds to go. Okay, that's a hike, 25 basis point hike, in line with the expectation of a 25 basis point hike to 0.5%. So here we go. So the ES, the S&P 500, seeing that move towards the downside as expected there. The dollar yen did see that initial move towards the upside. So look at the other places. So let's look at the 2-year. 2-year seeing some movement. The bond price seeing some movement towards the downside. So we got the 30-year bond price seeing some move towards the downside as well. Cable moving towards the downside. Euro dollar moving towards the downside as well. And so even with this choppy sentiment that we're getting from the markets, did see that reaction or strong reaction from the S&P and also the dollar as well. So here we go. So Bullard, unsurprisingly, was the one who voted for 50 basis point rate rise. As said, that's not unexpected. Okay. See what else we're getting from this here, from the comments. Okay, so inflation levels remain elevated on supply side issues and the pandemic. They see unemployment at 3.5% at the end of 2020 and 3.5% at the end of 2023. So most Fed officials see as many as 7 rate increases in 2022. Okay, so that's confirming Goldman Sachs' point of view that they're looking for 7 rate hikes for the rest of the year. Interestingly, Fed talking about Ukraine, saying that the Ukraine war may create inflation pressure and slower growth. So that's again the Ukraine war potentially having an effect on the US economy. What else do we have? So they see the Fed funds rate at a median of 2.8% by the end of 2024, or in a couple of years' time. What else are we seeing here? Let's see, what else we got here? Okay, what else are we getting from here? So there's overall so the US 10-year-old treasury yield rises 2.2 to 2.212%, high since May 2019, after the Fed raises rates by 25 basis points. Okay. So what else we got coming through? So also swaps showing 190 basis points of 2022 tightening versus 181 basis points pre-Fed. Okay, so let's mark out some of the reactions here. So did anyone trade that release? Just to kind of realize how my mic down there for a second. Did anyone trade that release there? Did anyone who traded that release? I think Galaxy One, you said you traded dollar, or you went long dollar yen. Maybe you just said long dollar yen. But yes, so for anyone who wants to stay up to date with what we do, if you liked what we presented here today in MacroAce, and you want to continue to stay up to date with what to expect and the releases as well, then the link that I've just posted in the chat, if you sign up to that mailing list, so tonight I'll be sending out the video for the retail sale, the US retail sales and inflation data, EIA inventories, which was no surprise when we had a positive news from the FT where the market didn't have a reaction because there already was a reaction to the report. And then I'll also be putting out this video here for the FOMC interest rate decision. I know we've got about, I think we'll just kind of like a little pause before we get into the rates, before we get into Powell's press conference.